It is important to understand the various property tax deductions and credits you can take advantage of. While the IRS says you aren't allowed to deduct any property tax that you pay from your taxes, either from state or local taxes, you may be able to qualify for other tax deductions and credits for homeowners. By taking advantage of these, you will lower the amount of taxes you pay and get to save more money. Save money on property tax credits. There are a few ways to save money on your property taxes, and one of the best ways to do so is by taking advantage of property tax credits. Credits reduce the amount of tax you owe, and there are credits available at the state and federal levels. The federal government offers several property tax credits, including the Earned Income Tax Credit, the Child and Dependent Care Credit, and the Mortgage Interest Deduction. The Earned Income Tax Credit is available to taxpayers who earn low or moderate incomes. It is a credit that is given to low-income workers based on their income and the number of children. It is calculated and given by the federal government. If you are eligible for it, then you may be able to file for it on your taxes. There are several things that factor into it, including how many children you have, how many hours you work, and what your income is. If you have any questions about the Earned Income Tax Credit, you can contact the IRS in more detail. The Child and Dependent Care Tax Credit allow you to receive a credit on your taxes if you paid for your dependents' needs. For example, if you had to pay for the expenses of raising a child or paying for a babysitter for your disabled spouse, you will get to receive a credit for the expenses. The amount you can receive is dependent on your income, how many children you had, how much was your total expense, and how long you had to do this. The mortgage interest deduction is a deduction homeowners can take on their taxes. If you itemize your taxes and have a mortgage, you can take this deduction as it lowers the amount of money you owe the government. If you have a traditional loan, you can deduct the interest you pay on your mortgage. For those who have an FHA or VA loan, you can still take the deduction, but you have to be careful because some of the benefits of those loans are not deductible. The interest you pay on a mortgage is considered to be an investment, because it allows you to own property and enjoy some of the benefits of that property. If you use your property for business purposes, you can't deduct the interest you pay on the mortgage, because business and investment interests are two different things. To learn more about the property tax credits available in your state, visit the website of the State Tax Department.